All right, this is the Texas Elite Advisory monthly clients and friends webinar, and I'm Vern Bell. First thing I want to do is turn off this video screen. So you'll be looking at the slides, but there's really no need to be looking at me. I'll leave my mic on and we'll get started right away. So the agenda today is fairly brief. We're probably going to take a total of just about 20 minutes. And here's the things we're going to talk about. First, we'll talk about what we do. This is really an intro for newbies, people that are not clients or have not visited any of our other events and are therefore not acquainted with the business. That'll take maybe 5 minutes tops. Then we're going to focus on the main topic, which is volatility. We did this a bit last month, and we're going to get further into it, identify some strategies, some investment strategies that are, in our opinion, highly at risk, and look at alternatives to avoid disaster and continue to grow assets. And we'll talk about scheduling meetings a little bit and move on to Q&A. So what do we do? We're portfolio managers, advisors, and financial planners. You'll see that on our website. In a nutshell, these are the things that we do. But because of time restraints, I'm going to focus just on the top bullet today. That's portfolio managers, what we do in managing portfolios, and our internal investment strategies particularly. So we serve both retail clients and other investment advisors with our elite relative value strategy. It's a proprietary value investment strategy, and from its inception in April of 2008 to the current date, the elite relative value strategy has outperformed its benchmark and never had a losing calendar year. That's pretty amazing in this world. You can check out the Elite Relative Value Strategy's performance history by going to our website and then hover your pointer over the strategy menu, which is right here. Then click on performance, which is right here. And this will take you to Theta Research, their website. Theta Research is a third-party firm that monitors our performance and provides validated historical data and charts. You'll need to enter your email, and Theta Research will send you a special link that you can use to access our data. When you gain access to our web page on Theta Research's site, click on this chart right here. And then the best thing to do is to click on the monthly statistics button over here. And that'll take you to our from inception data, which is updated monthly and goes all the way through February at this point in time. There'll be detailed tables in there that go through month by month what our performance was versus the benchmark. And then, of course, this nifty little chart that gives you a visual representation. We do have two investment models, the value model I mentioned and a technical model. And today I'm going to focus on the foundation of our YPro technical strategy. In last month's Client and Friends webinar, I spoke about how volatility returned to the market. This past week, both the Dow Jones Industrial Average and the S&P closed down and down convincingly. At this point, we're in solid correction territory and facing the prospect of a bear market. There's an old saying in the market, stairs up, elevator down. And you can see the beginning of that elevator down on this chart right here. And I just popped this chart off, I believe, this morning early. So you can see the slow walk up, but the beginning of the fast walk down. Fast ride down, that is. So this month I'm going to focus on avoiding disaster should the market continue a downward slide. So Benjamin Graham is known as the Dean of Wall Street, and during his lifetime he was a fabulously successful investor and a great teacher. In fact, Warren Buffett says everything he knows about investing, he learned from Ben Graham. The most important lesson is that risk management is far, far more important than the pursuit of returns. Graham's quote up here points that out pretty effectively. The essence of investment management is the management of risk, not the management of return. So first, let's explore what the financial services industry's standard practice for risk management is. It's the well-known and widely used 60-40 portfolio. The risk management piece embodied in the standard 60-40 portfolio is found in the 40% bonds. They would be ever present along with a selection of stocks. Bonds are intended to act as a buffer against the higher volatility and larger potential losses of stock positions. The 60-40 approach to risk management is essentially constant, what we call static risk management, or unchanging. But we have to ask a question at this point. Does static portfolio provide the level of risk management that average investors expect? Does it really limit the damage as we would hope and expect? Another widely followed academic theory is that diversification protects investors in declining markets. Here's an example of what many in the industry like to call the well-diversified portfolio. This kind of asset allocation is also referred to as buy and hold, or MPT, modern portfolio theory. Other than an occasional rebalancing, the well-diversified portfolio doesn't change. Therefore, it too is essentially static. The idea is that with a well-diversified portfolio, different types of investments will march to the beats of different drummers. And so theoretically, while some asset classes are going down, others might be going up. This chart shows that diversification across 9 non-fixed income, that's non-bond, income asset classes work pretty well in a bull market, producing a very wide dispersion of returns, almost 300% from top to bottom. Even though all these asset classes were generally uptrending, they definitely went at different rates, providing for the desired diversity. However, in a bear market that followed, the dispersion of returns collapsed dramatically. The supposed benefits of diversification across these 9 asset classes just weren't there. An almost 300% dispersion of returns during the bull market shrank to a tiny 15% dispersion of returns during the bear market. This collapse of dispersion means that the correlation of the returns among these asset classes skyrocketed. Correlation is the tendency of one asset class to behave like another. This proved the wisdom of the old Wall Street adage. The only thing that goes up in a down market is correlation. So here's the big question. Is it possible to identify times when more risk management should be applied and times when less risk management should be applied? We think the answer is yes, using our market condition identification methodology. This method combines a quantitative, fact-based assessment of 3 different market timeframes to an overall market health. There's a short term, which is weeks to months, an intermediate term, which is quarter by quarter, and a long term, month to years. These are all separate calculations that are made. Then these calculations are combined using simple math. The sum of the positive time frames determines the market condition reading. So if you look at zeros here, you end up with a 0. If all of them are 0, then you're definitely clearly in negative territory. If one of them or 2 of them are in positive territory, then we would consider this to be a neutral market. And if they're all 3 ones, all 3 positive, then we're on a 3 or a positive footing. So I want to emphasize this point that just knowing these market conditions is not a strategy. The strategy has to be built on this foundation. As you can see on this chart, the market declines are dominated by yellow and red periods, while the market uptrends are dominated by green with a smattering of yellow. These statistics show how powerful the market condition identification system is. If we take a look up here at the negative days, there are only a total of 307 negative days, which is kind of a surprise. That's only 7% of the total days. Total days, of course, is 4,278. The period is from January 1 to December 31 of 2017. So you're into 17-year time stretch there, pretty good range. And during this negative period, the maximum drawdown, this is what you'd have to suffer at some point, is 62%. Most people simply wouldn't tolerate that. They would be out of the market. Neutral, almost half the days are neutral, and that total cumulative gain through that period is 2.6%, but still you'd have to suffer through some pretty stiff drawdowns. So we want to manage that as well. And positive, 226 days or 47% of the days, most of the days are actually positive by this measurement. And during that period, if you just were in that period in the S&P, you'd have had a 17.9% gain, not considering fees and expenses and so forth. The maximum drawdown one would have experienced was only 10%. Most people could tolerate a 10% drawdown. So these statistics demonstrate a pretty powerful market condition identification system, I believe. So if we just zero in on this disastrous decline from late 2007 to early 2009, you can see that the heightened yellow or maximum red risk management mode for the entire period. So here you can see we've bubbled that out, brought it over here, and you're just seeing reds and yellows all the way down until we find a point at which the indicators indicate the market is recovering. In fact, the system is so effective that maximum losses would have been a tiny 6.7% versus a 34.7% maximum loss for the 60/40 static risk management solution, the bond and equities solution. Even better, the dynamic risk management solution would have finished the whole period with a tiny loss of just 1.63%. So that's pretty amazing compared to, as you can see, the S&P here is cratered off pretty badly. It also does better in the recovery years. So you can see the 15.57% for the dynamically managed portfolio versus the 13.25 for the S&P during the positive years. So the real benefit comes when you combine the two. And it's really apparent here. You can see that we're going over the whole period, we're combining the two, and the dynamic risk management example gives you a 13.8% per year compound return, and the static only gives you a 6.81%. And this results in significantly larger gains on a $100,000 investment. What we looked at before with the drawdowns would take many, many people out of the market entirely, causing them to miss all of the increases. And I've actually seen people sell out right at the bottom and stay there, which is horribly sad. So dynamic risk management does require patience. It requires a good understanding of the principles of successful investing, but the reward is ample. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. So in order to avoid disaster, you need a plan, and that's where we can help. To avoid disaster in your 401k, you can take advantage of our Active 401k program. Just go to our website and click on the top menu item, Active 401k. It uses the same technical approach as the YPro strategy. So it's also designed to manage actively and to react to market changes. Don't forget to give me a call, though, for a significant discount. So when I see headlines like this one right here from thestreet.com, it reminds me of that dot-com bubble and the September 2008 market crash. I grew up in the plains of Nebraska, and the spring is absolutely beautiful there. But it brings a particular risk that you just don't dare ignore, and that's tornadoes. In spring of 1966, the high school I attended was dismissed for one full week while we all pitched in to clean up a nearly mile-wide swath of destruction created by one such storm. Everybody in town had a basement or storm cellar. You just had to take precautions against disaster. The vast majority of investment advisors don't have a credible disaster plan. Portfolios are typically static. They don't change at all as financial tornadoes approach. So here's a question. Do you believe your financial advisor is taking into account the perceived level of risk in the market and adjusting your portfolios accordingly? If not, let's get together and discuss a different approach. My phone number and my email address at the bottom of this slide right here. And with that, I'm going to wish you a very, very pleasant Saturday. Goodbye.